So I hope you guys are enjoying your holidays and your trips and you're somewhere sunny taking a look at this. And given you have all this time off, I want to take an opportunity to give you guys an idea of what the plan is. What is the next step? So the first thing is I want you to take a look at the screen. I got this picture as one of the TV shows in the business networks will show you. Look at all these primary companies and what the performance has been so far this year. Obviously, our portfolio has not nearly done that like that. We're pretty much level, and that gives us a great opportunity to start picking up some companies. Any shareholder, any long-term investor that already owned these stocks and that it's down all of this year, as long as they hang on to them, these companies are good. They'll eventually come back and do profits, at least most of them. And the stock will come back. But our opportunity is going to come from the fact that we have pretty much all our capital still here. We have giant cash positions. Thanks to the market, we're going to be able to buy them a lot cheaper. So on one hand, playing defense this year paid off quite a bit. We're in a good position. And sometimes, like any hockey player will tell you, sometimes you just have to play defense. You're one man down, and there's no point in trying to be a hero. So that's what 2022 was about. What does 2023 look like then? The reason why we're not running in to buy anything yet is because if you watch how the plumbing, the underlying baseline of how the investor market is moving, things are still clogged. There's still a lot of pressure on pension funds, on those big investors, on a lot of retirees that are starting to get very nervous because their bonds are down 20%, the market is down 20%. Some of the stocks, like the best stocks in the world, are down 50, 60, 70%. And they are concerned about their retirement. Not only, and also banks are also worried about liquidity. Are they going to get paid for all the money that they're lending people? If you look at housing, just about anything is down quite a bit. There's still more to go. The liquidity in the underlying part of the baseline of the market. I don't want to make things complicated, but just the core investment fundamentals are still not there. There's no liquidity. There's a higher risk than there was last year that we're going to have them be forced to sell their shares. Now, this, I don't want you to think is a testament to the health of the companies. The companies themselves are doing well. They're selling, they're making profits, they're moving ahead, and they're making the adjustment that is needed to get to what is coming to be a recession. So I'm seeing how companies like, for example, Amazon are having to rent out some of the space on the airplanes because their airplanes are not traveling full of packages anymore. Meta, Google, they're firing employees, they're readjusting. So this kind of reset is healthy because companies are starting to be more efficient with the money. And as an investor, we want them to do that. However, coming in the other side of the year, now that the policies are different, the economy is moving differently, the plumbing is different, we are yet to see how the earnings are going to be. We have inflation, we have higher costs, we have China reopening, and the politicians are also not helping because the companies are now having to invest in moving their warehouses and their manufacturing plants from China somewhere else. So that's a cost, but it's not a cost to grow. It's not an investment in the company. It's actually a cost to rearrange everything. And our employees are going to be as cheap in labor as the Chinese were. All these questions need to be answered still. And we're going to be watching, but I'm pretty confident about 2023. I think there's going to be a lot of pressures that are going to force selling, and we're going to be buying. So we're going to slowly be buying into what is likely going to be a weak year. And we're moving our team now in the hockey match. We're moving from full-on defense and we're bringing out our offense. We're putting back our good players. We're going to start allocating money. And I think 2023 is going to be really good for any investor that has cash like we do, because we're going to have a chance to buy great companies for discount prices. I want you to be pumped whenever you see the market going down a lot, and not nervous. Nervousness is how you make a mistake of liquidating or getting your cash out. We don't need the money anytime soon. We're the ones buying, and we're going to be buying at prices that we haven't seen in 5 or 6 years in some of these stocks. I was looking at the list, and companies like Amazon is at 2018 levels, PayPal 2017, Adobe at 2020 levels. These are 4 or 5 years worth of earnings and growth and profits, and that are not being accounted for by the stock market because of the clogs in the plumbing underneath. And once we load up, we're going to be expecting to fully load up probably right around the time when companies are giving their worst earnings outlook of the year. And that is yet to come. That moment for anybody watching the regular news and the day-to-day, it's going to be a moment that does not look like it's right. But don't forget that the stock market usually front runs. The stock market is about 6 months or more ahead of the economy. So while people are losing their jobs, while the recession is screaming out, and that is already being priced. And that's why you see these stocks down so much. And that's when we're going to be coming in and buying for a long-term return. Earnings will resume eventually. We'll come out of the recession, and we will have picked up some great assets for big discounts. As far as what you probably know by now, you've seen on the portfolios, what are the companies that we like the most, but they're definitely companies that are profitable, that are almost unaffected by a recession, or affected very softly, Costco, and that are able to navigate the different circumstances to get through, because the stock and the company value will be determined by their profits and their earnings. So as long as we see these companies showing steady earnings, that they're adjusting to all these geopolitics and inflation, then they should be worth a lot more on the other side. The one region that I'm worried about the most with these shuffle is perhaps Europe. We are probably going to have to take a serious look at some of the investments we have in Europe, because they're really not faring well, and energy and some of the manufacturing costs for them are going up too much. So we're going to have to re-rate and take a look at that. But as far as the rest of the world, you've probably seen how Turkey and China are performing very well. And some of our international investments have really kept things going well and moved our portfolio very nicely. So those are not going to be that cheap anymore. We're going to be looking at where things are suffering the most, which is going to be around here. And good luck. If you have any other questions, let me know. I'll be happy to answer. And I hope to see you guys again soon. Enjoy your vacay.